of this into the marketplace. And Uju Nsofor, who is one of the research analysts, the team at Afrinvest, is the first lady here on the program this week. Good morning.
Good morning.
It's good to have you. How had a nice weekend?
It was fine.
We had the entire inflation to chew Thursday, Friday. Then we have the third quarter GDP this morning. But just before, I will continue the conversation as to what all this means for the market. From downtown Lagos, we're getting through to Bismarck Rewani, who is an economist and the chief executive officer at Financial Derivatives Company. Mr. Rewani, thanks for joining this conversation.
Thank you for having me.
You are the one out of the studio, so we appreciate your executive time. A lot of data this morning and economic news to chew about. Give us your first word.
First word is that 1.4 is good. I think that's higher than I anticipated. But it's slightly lower than consensus opinion. But more dangerous is the fact that it's all oil dependent. If you look at all the other variables, everything was negative apart from electricity. So we are more oil dependent than ever now, and that's going. And if OPEC is to enforce its compliance rate of 1.8 on us, it therefore means that in the fourth quarter we're going to see a reduction in oil production. That is the danger we are in at this point. We are vulnerable to exogenous shocks, and this has pointed it out.
And this seems to be a little bit in line with the last Moody's ratings that we got about how vulnerable we are to these exogenous, if you call it, issues.
Yes, it is. But let's go back a little bit. Inflation at 15.91, cumulative inflation reduction this year is about 2.8%, which is excellent news for us. Now GDP is up, but the question is it sustainable? The time lag between policy and effect is beginning to catch up with us. So I think fourth quarter will do good, but won't be where we want to be. So we are vulnerable there. Finally, the whole idea of having the economy is constrained by high interest rates. We've got to do something about that. They got to do something about it. Either they do it today or latest by January. Even January will be too late. So something has to happen immediately. Something has to happen immediately.
That's Mr. Rewani's words there. Uju, how much do you think should happen immediately from the monetary policy side of things, whether it's the MPC meeting starting today, to influence the marketplace?
Well, definitely we are actually in support of an easing, but is this the right time to actually ease rate, to reduce the benchmark rate? We do not think so. I mean, if you look at GDP figures, yes, we grew 1.4% year on year, but if you look at non-oil GDP, it actually contracted. The manufacturing sector, look at PMI readings have been up over 50 points. FX liquidity has actually improved, but nonetheless, the sector actually contracted on a year-on-year basis. So this sort of gives, is actually something the MPC committee ought to deliberate on. I mean, should we reduce the benchmark rate in order to stimulate growth? All the policies we put in place, but still the services manufacturing sector are still contracting. So it's definitely something that they should look at.
When Godwin Emefiele and the rest of his team begin to sit together this morning, these GDP numbers is not going to be so positively good. In terms of the headline, yes, but you think the devil in the details will not likely make them go for an easing?
Yeah, definitely. If you look at now, there are more calls for a dovish stance. I mean, look at the reduction in the fixed income market. Then also, you see that the federal government, they've actually opted to reduce cost of borrowing by going to the foreign debt market. Last week, they embarked on a roadshow in order to source for external finance. This is in order to reduce the cost of borrowing. I mean, there are downside risks to continue borrowing at this rate. Also, you look at FX. Yes, we've recorded improvements in this sector due to the timely interventions by the CBN governor, but this is largely on the back of improved oil production, which has shot up our reserves and sort of given leverage in order to do timely intervention. But then again, despite the fact that the CBN has been able to address FX stability, price stability is still a major source of concern. The moderation we've seen in inflation rate this year has largely been due to a high base effect. I mean, we are running out of high base effect. What then happens? Food inflation is currently at an 8-year high of 20.3 thereabout. I mean, this is something that the Monetary Committee ought to look at. And do we then reduce rates and sort of jeopardize the improvements we've seen so far in the economy?
Very interesting thoughts from Uju here. Mr. Rawani, look at the lowest ranking or lowest scoring that we had in the latest Ibrahim, which was on sustainable economic opportunity, 42.3. That is really, that's not good.
No, it's not good. But let me first respond to the lady's point on interest rates. That's the first time I've heard in economics that anybody will say that when there's a contraction in economic activity, you should actually increase interest rates. Of all the factors there, of all the variables, every one of them was negative. What do you do when you have negative growth? You stimulate the sector by giving them more money. The only sector that grew positively was agric, and agric are beneficiaries of intervention funds at 6, 7, or 8%. What this lady is saying is that we should maintain high interest rates of over 20% and allow this sector to get strangulated. That's not the answer. The answer is to bring down interest rates so that the sectors can borrow and output can increase. Increased output will improve, will actually sustain the inflation rate going downwards. Now, coming back to the Ibrahim issue, Ibrahim Foundation has actually carried out this study. We have performed suboptimally in terms of economic opportunity, but the truth is that we are doing better because in the area of governance, in the area of security, and the area of accountability. But what we need to do is to extract and exploit the economic opportunity, which we have failed to do so far. One of the reasons for this is because we have been unable to stimulate economic activity with lower interest rates to increase output. This is going to come as we go along. I think the central bank will either have to do it today, tomorrow, or latest by January. But I think January is even too late. They have to do something about it today.
The consensus, Mr. Rawani, among a number of analysts is that interest rates should still, the headline parameters should be kept unchanged because the growth is there, but it's still very soft. Now you're saying it should be today, tomorrow, the 21st, or we should wait till January, but not even March. You think that will be too late? By what margins would you want interest rates lowering to go?
First and foremost, if you say interest rates are too high and you want to stimulate growth, then you've got to bring them down. There's an inherent contradiction in what you're saying. But I think we have to go directionally, move down by 0.25% policy rate. But more important, even if you leave the policy rate unchanged, you must bring down the treasury bill rate somewhat, at least by 100 basis points, and also reduce, give back part of the CRR to the bank so that they can have liquidity to lend. And that's what we have to do. Just look at the sectors. Agric grew by 3.06%. Agric benefits from intervention funds from the Bank of Agric. Agric benefits from central bank intervention. Agric benefits from the exchange rate changes that have taken place, which has made people to change their behavior. So you see rice, tomatoes, and all of these issues, all of these products showing positive growth. We need to stay and stay the course. Don't forget that if you do not lower interest rates, activity will not increase, lending will not increase, output will not increase.
Thank you, Mr. Rawani. Obianuju, in terms of, we've seen one or two analyst reports say, look, it is time to start cutting interest rate, even though a very huge number, more folks still tend towards the central bank that says, let's hold on a little bit. Now we're having a few voices say it's getting too hot in the kitchen. We need to reduce the heat a little bit because we can't get out of the kitchen. That's where the cooking gets done, so we have a very decent meal. So we need to do that. If you guys are looking at it, by what margin? Mr. Wan is looking at 0.25%. Even if we're not doing anything with the headline, perhaps we need to put more money for the banks to lend. But we remember, the central bank has always said the banks are not transmitting this money to borrowers. So do you think we have a dilemma here?
Yeah, definitely we have a dilemma. All the points are listed ahead. I mean, the appeal is there for the monetary authorities to actually ease rates. I mean, you look at our cost of borrowing, you look at the recent GDP numbers that came out, the non-oil sector actually declined, the manufacturing sector actually declined. So yes, definitely there actually calls for easing. But then again, you have to look at the global landscape. oil price now has stayed above $60 a barrel. I mean, how sustainable is this? Is this a short-term cycle? Is this a long-term cycle? I mean, what definitely the GDP numbers indicates that we are currently an oil-driven economy. So what happens if there's an external shock there? I mean, are we back to square one? So definitely, these are things that the monetary authorities will actually sit on and deliberate. But however, we believe we are in support of an easing, but we do not believe that this is the right time to actually reduce the benchmark rate.
Mr. Omofaye, a quick one. How do you think we should use this oil boom, technically speaking, in terms of volume and price stability to grow the economy? Where do you think we should pump this very quickly if we are doing some policy rate easing?
No, obviously we have our parameters clearly stated. The budget is there that we are going to do at least 30% capex. The GDP is an output measure, not a price measure. So even if the price goes to $100 a barrel, it's the number of barrels that we produce that is being measured. Our production cannot increase past 1.8 right now because we are being measured and we have to enforce the OPEC cap. Now, what other sectors are you going to actually stimulate? Manufacturing, agriculture should go further, trade, electricity has gone up by 11%. We need to put money into these sectors, and the government has to start by stimulant. But investors are responding to the environment. You cannot have tight monetary policy when there's tight monetary conditions. This is the situation. There's some fear that if this happens, inflation will go out of hand. I do not agree with that fear, because you need courage to do these things. And don't forget, a lot of voodoo economists are going to be telling you about how to tighten at a time like this to sustain inflation. But that's, with all due respect, that's voodoo economics. In pure economics, we need to do what we have to do to achieve what we want to accomplish.
Okay. Obianuju, finally, whichever way the central bank decides tomorrow, or the MPC decides tomorrow, how do you think the market will move forward from here?
Well, definitely for the equities market, they've been affected with a number of factors. We saw the reclassification and removal of certain stocks from the MSCI frontier market thereabout. So this sort of affected sentiment towards this stock, and we saw a bearish trend. The market was down 1.1%. We believe that investors sort of now will be awaiting the outcome of the MPC meeting, because now more than ever there are actually dovish calls to actually reduce the benchmark rate. So we sort of expect a negative performance to this week. For the fixed income market, there's a bond auction coming up this week. Investors are more likely to key into that side of the market, given that the FGN embarked on a roadshow last week, and in order to reduce the cost of borrowing. So we ought to see performance there to be skewed towards the bullish side.
Uju Nsofor from Afrinvest, thank you very much, one of the research analysts. Mr. One.